In April 2020, Luckin Coffee admitted it had fabricated approximately 2.2 billion Chinese yuan in sales. That is roughly 310 million US dollars. Luckin had gone public on the Nasdaq just 11 months earlier. Its IPO raised $651 million. Its market cap briefly touched $12 billion, and almost none of that story was real. Luckin Coffee was not a coffee company that committed fraud. It was a fraud that sold coffee. To understand how this happened, you have to go back to 2017. China was not a coffee culture. Tea had dominated the country for centuries. Starbucks had been there since 1999 and still held less than 15% of the urban coffee market. But China's urban middle class was growing fast. By 2017, more than 400 million Chinese consumers lived in cities. They were younger, faster moving, and increasingly mobile first. Someone saw an opening. Her name was Jenny Qianjia. Chen had spent years running the car rental company UCar, owned by entrepreneur Charles Lu Zhengyao. Lu Zhengyao, Luckin's chairman, had built UCar by flooding the market with subsidies, growing fast, going public, then cashing out. That playbook, applied to coffee, was the entire idea. Luckin launched in Beijing in January 2018. Its model was built for speed. No cash, app-only ordering, small format stores embedded in office buildings and campuses. Everything was designed to eliminate friction and collect data. To pull customers in, Luckin offered deep discounts. Buy 2 drinks, get 1 free. First cup completely free for new users. It was burning cash deliberately. In 2018 alone, Luckin lost roughly $232 million while opening more than 2,000 locations. Investors did not flinch. They had watched this movie before: subsidize growth, dominate a market, monetize later. Luckin raised $200 million in Series A funding in July 2018. Its valuation hit $1 billion. Less than a year old, $1 billion. By the end of 2018, Luckin had more than 2,000 stores across China. Starbucks had taken 20 years to build that same footprint. By January 2019, Luckin had raised another $150 million and announced plans to open 2,500 more stores that year alone. The financial press called it the fastest growing food and beverage company in history. In May 2019, Luckin listed on the Nasdaq. It raised $651 million in its IPO. Shares opened at $25 and climbed to over $50 within months. American institutional investors were buying in. BlackRock owned a position. Louis Dreyfus took shares. The story was irresistible. The Starbucks killer, built for mobile-first China. But a short seller in the United States was reading the numbers differently. Muddy Waters Research, founded by Carson Block, had built its reputation exposing Chinese corporate fraud. In January 2020, Muddy Waters received an anonymous 89-page report. The report alleged that Luckin had systematically inflated its customer transaction counts, average selling prices, and total net revenues. The researchers had stationed employees at 981 Luckin store locations across 100 Chinese cities. They filmed over 11,000 hours of in-store video and collected over 25,000 customer receipts. What they found? Actual transaction volumes were roughly 69% lower than what Luckin had reported to investors. Muddy Waters published the report on January 31st. 2020, Luckin's stock fell 11% that day. Then Luckin did something extraordinary. It called the allegations baseless and continued operating. It worked. Temporarily, the stock recovered and Luckin raised another $865 million in convertible bonds and stock offerings in January 2020. Those investors would lose almost everything within 90 days. On April 2nd, 2020, Luckin issued a regulatory filing. Its own audit committee had uncovered the fraud. COO Jan Liu had directed employees to inflate net revenues by 2.2 billion yuan starting in the second quarter of 2019. The scheme was not rogue. Multiple senior employees were involved, and the inflation covered essentially the entire period Luckin was publicly traded. Luckin's stock collapsed 75% in a single day. That erased roughly $5 billion in market value in hours. Now, it is worth laying out exactly how the fraud worked, because it was not simple. It was structured. Luckin inflated revenues by creating fictitious corporate customer orders. It set up shell coupons and voucher programs that appeared to show customer spending that never actually occurred. Real cash went out as subsidies to actual customers, creating genuine transactions at the bottom. But inflated phantom orders were layered on top to multiply the reported totals. The real transactions gave auditors enough to find something real, while the fake layer inflated every metric investors cared about. Ernst & Young, Luckin's auditor, had signed off on the 2018 annual accounts without detecting it. The fraud made Luckin's unit economics look far better than they were, which justified every successive capital raise. Each round of funding made the next round easier. The fraud was self-financing, and an internal whistleblower had flagged concerns in January 2020, 3 months before the public disclosure. Leadership buried it. Then, when the board finally investigated, evidence pointed not just to Liu, but to the chairman himself. 5 compounding failures, and each one protected the last. Luckin fabricated $310 million in sales revenues that never existed. It burned investor cash to subsidize a growth story that justified further investment. It then presented those fabricated metrics to Nasdaq-listed investors through SEC-filed documents. An internal alarm was raised and deliberately ignored at the highest levels, and the fraud had been designed from the top, not discovered at the bottom. The consequences hit immediately and from every direction. On May 19, 2020, the Nasdaq delisted Luckin Coffee. Jenny Chan was fired. Jian Liu was fired. Chairman Liu Zhengyao lost board control. In December 2020, the SEC charged Luckin Coffee with securities fraud. Luckin agreed to pay $180 million to settle. In the United States, federal prosecutors in the Southern District of New York opened a criminal investigation into the fraud. Chinese regulators fined Luckin 61 million yuan, roughly $9.4 million, for market manipulation. Investors who had bought shares after January 2020 were almost entirely wiped out. The stock, which had peaked above $51 per share, was trading below $2 by the time delisting was complete. But then, something strange happened. Luckin Coffee did not close. New management came in, the subsidies stopped, the stores stayed open. By 2022, Luckin had returned to profitability for the first time, reporting a net income of 564 million yuan in its third quarter alone. By the end of 2023, Luckin had nearly 14,000 stores across China. It had surpassed Starbucks in Chinese store count, which raises a deeply uncomfortable question. Luckin lied its way to scale. Then, once it had scale, the underlying business turned out to be real. That is not a vindication. It is something more troubling. The $310 million that was fabricated on Luckin's books was real money that came from somewhere. It came from investors who bought a story they were not given the tools to verify. Those investors lost billions. The company survived. The founders faced consequences, but no prison term in a U.S. courtroom. Charles Liu Zhengyao denied involvement, was never criminally convicted in China, and later launched a new startup. In April 2020, Luckin admitted it had fabricated 2.2 billion yuan in sales. That was the moment everything came apart. But Luckin Coffee's story is not really about accounting fraud. It is about a specific moment in history when growth metrics became more valuable than the revenue generating them. When venture capital moved so fast that 89 pages of surveillance footage could not stop an $865 million raise from closing. When the story of a company was worth more to markets than the actual company. The fraud worked because the underlying market thesis was correct. China did want fast, cheap, mobile-first coffee. Luckin had identified a real gap, and then decided that reality was not growing fast enough. So, it manufactured a faster reality, sold that to the world's most sophisticated institutional investors, and nearly got away with it. What stopped it was not a regulator. It was not an auditor. It was 981 strangers with cameras and 11,000 hours of footage. Luckin Coffee is still open. The cups still have the Blue Deer logo. 14,000 stores, real customers, real coffee, real profit, built on a foundation of $310 million that never existed. The lesson of Luckin Coffee is not that fraud never works. It is that in markets drunk on growth, the most dangerous lie is the one that turns out to be slightly true.